Welcome to the deep dive. This is where we dig into the sources, the data, our own research notes, really, to pull out what actually matters. Think of it as your shortcut to understanding the core story. Oh, and before we really jump in, if you're finding these deep dives valuable, please do remember to like and subscribe to the Stock Analytics AI YouTube channel. It really helps us out. And just a quick heads up, our $4.99 a month members, you get priority deep dives on the tickers you suggest in the comments. So keep those coming. Today, we're looking into a really fascinating company. You might not know the name, KLA Corporation, but they could arguably be, well, the unsung kingmaker of our whole digital world. Ticker is KLAC, by the way. So our mission today, figure out if KLA, this critical supplier of process control tech in the semiconductor ecosystem, really deserves that kingmaker title. By the end, you'll have a much clearer picture of, the bull case, the reasons to be optimistic, and the bear case, the big risks. It should leave you with a key decision point to think about. Okay, let's get started with Chapter 1, business analysis. Right, so KLA Corporation trades on NASDAQ, ticker KLAC. We're using June 19, 2025 as our reference date. And the closing price then was $871.16. Keep that date in mind for the data. Now, KLA's business model, it's often called picks and shovels. You've probably heard that analogy.
Yeah, it's a classic one. They aren't actually making the chips that power, everything from your phone to massive AI data centers. Instead, they provide the absolutely essential process control and yield management systems, the tools that all the chip makers need to actually make those complex chips work reliably.
It's like the gold rush idea, right? The folks selling the picks and shovels often made steadier money than the prospectors hoping to strike it rich. KLA is selling those crucial tools for this silicon gold rush.
It's a really robust model. It breaks down into two main streams. About 75% is from selling new equipment, but that other 25%, that's their services segment. It's very stable, high-margin revenue.
And that comes from servicing all the machines they've already sold.
Exactly. They have this huge installed base of equipment out there in fabs all over the world. And what's really smart about this services division is how it acts like a financial shock absorber. The semiconductor industry is famously cyclical, boom and bust. When new equipment sales inevitably slow down in a downturn.
But that service revenue keeps coming in.
Precisely. It helps smooth out KLA's overall results, makes them much more resilient than a lot of companies just selling the big machines.
And you really start to appreciate how vital KLA is when you think about how incredibly complex modern chip manufacturing actually is. I mean, the analogy of building skyscrapers on a fingernail.
It's not far off,
Right.
where each floor is just atoms thick. It's unbelievably precise. A single microscopic flaw, something you could never see, can just destroy an entire wafer that cost millions to produce.
Ouch. Yeah, very unforgiving.
And that's exactly where KLA's products, their all-seeing eyes, become absolutely indispensable. Their whole portfolio is designed to catch those potentially catastrophic errors. They have wafer inspection systems. These use super advanced optical and electron beam, e-beam technologies. They scan the wafers for defects smaller than a wavelength of light.
Wow.
Then their reticle inspection systems. The reticle is like the blueprint, the stencil for the chip pattern. KLA ensures those are perfect before you even start printing billions of transistors.
Makes sense. Garbage in, garbage out, right?
Exactly. And increasingly important is their data analytics and software. This uses AI, machine learning, to analyze the mountains of data coming off the inspection tools. It lets manufacturers actually predict problems, tweak their processes in real time, and fundamentally improve their yield, the percentage of good chips per wafer.
So the more complex the chips get, the more valuable KLA becomes.
Absolutely. As transistors shrink towards just a few nanometers and you stack layers in 3D, the probability of defects just skyrockets. So KLA isn't just selling machines, they're selling like an essential insurance policy against yield loss. That gives them huge pricing power.
Which leads us nicely to their market position. They aren't just a player, they're the player.
Oh, completely dominant. They have something like 50% market share in their core process control and inspection space.
50%.
Yep. That's roughly 4 times larger than their nearest competitor. It's a near monopoly in many segments. And this wasn't overnight. It comes from decades of innovation, strategic moves like a key merger back in 1997.
And that dominance is reflected in their index inclusion, right? NASDAQ 100, S&P 500.
Definitely. It signals their importance. And their core value proposition to customers, the chip makers, is really clear. KLA is the yield maximizer. They directly helped customers make more money by preventing defects, getting more good chips off each wafer, and speeding up the time it takes to get new chip designs into high-volume production. They're a strategic partner, deeply integrated, not just some vendor you swap out easily.
And looking at the bigger picture, the whole semiconductor industry has these powerful long-term growth trends behind it.
Undeniably. You just look around. AI, 5G, autonomous driving, the Internet of Things, all these megatrends demand more and more powerful, complex, and critically flawless chips.
Demand flows right through to KLA.
It does, and the forecasts reflect that. The process control equipment market, KLA's playground, is expected to grow from around $9.8 billion in 2024 to maybe $23.1 billion by 2034.
That's a pretty healthy growth rate.
It's about an 8.9% compound annual growth rate, or CAGR. And as the dominant player, KLA is just perfectly positioned to capture a huge slice of that expanding pie.
It's also good to clarify how KLA differs from other big names in the semiconductor equipment space, like Applied Materials or ASML.
Right. They all play critical roles,
Yeah.
but different ones. Applied Materials, AAT, and Lam Research, LRCX, they focus more on deposition and etch, basically building up and carving away material layers. ASML has that near monopoly on the crucial lithography step, printing the patterns. KLA, though, is laser-focused on process control. Inspection, measurement, data analysis, making sure every step is done perfectly.
When you compare their financials side by side.
KLA's profitability really jumps out. Looking at that June 19, 2025 data again, KLA's gross margin was 61.12%, operating margin 42.01%.
Yeah.
And return on invested capital, ROIC, a really impressive 36.77%.
How does that compare?
Significantly higher than AMAT or LRCX on those key margin and return metrics. ASML is a bit different because of its unique market cap and position, but compared to its direct process control competitors and even the broader equipment group, KLA's numbers are superior. It highlights their pricing power and differentiation.
Okay. We also need to flag the regulatory environment, those U.S. export controls aimed at China. That's a big shadow here.
A very big one. We'll definitely circle back to that in detail when we talk about risks. It's a central theme.
So what stops someone else from just copying KLA and competing? The barriers to entry must be huge.
They are extraordinarily high and getting higher. First, there's just extreme R&D and capital intensity. KLA spends billions on R&D. Building a new state-of-the-art fab costs, what, $15 billion, maybe more now? Then you have the intellectual property. Decades of accumulated knowledge, vast patent portfolios protecting their unique technologies in optics, e-beam, sensors, software.
Hard to replicate.
Very. Plus, economies of scale. Being the market leader with 50% share gives KLA massive cost advantages in manufacturing, sourcing, and R&D scope. But maybe the strongest barrier, high customer switching costs. KLA's gear is deeply embedded in these multi-billion-dollar production lines. Changing inspection vendors isn't like swapping out a printer.
No, I imagine not.
It would mean months of painstaking requalification, maybe re-engineering parts of the process flow, risking massive yield losses and production downtime. Customers are incredibly reluctant to do that. They're sticky.
So pulling this all together, KLA seems to have a classic economic moat, a really durable competitive advantage.
Absolutely. It's built on several pillars. Strong brand strength, they're the gold standard. Cost advantages from their scale. Network effects and switching costs, their tools are so integrated, they're almost the default. And unique assets, proprietary tech, patents, and importantly, highly specialized engineers and scientists. That human capital is hard to copy too.
Okay, this is a great place to pause for just a moment. You're listening to The Deep Dive. When we come back, we'll get into KLA's leadership and dig into their financial strength. Stick with us. Quick reminder while we have a second, if you're finding this useful, please do hit that like button and subscribe to the StockAnalytics.ai YouTube channel. And remember, members can suggest stocks in the comments for future deep dives, and we prioritize those. Your input matters. Welcome back to The Deep Dive. We've looked at KLA's powerful business model and market position. Now let's turn our attention to the people in charge. Let's move to Chapter 2. Management evaluation. In value investing, they always say management quality is key. It's not just about the assets, it's about who's running the show. What's the story with KLA's leadership?
Well, KLA's leadership story is actually pretty remarkable, mainly for its stability. The CEO is Richard P. Wallace. He's been with KLA since 1988.
Since 88. Wow.
Yeah, and CEO since 2006. That's a very long tenure, especially in the tech world. It speaks to deep institutional knowledge. And crucially, he has a technical background. He started as an applications engineer, worked his way up.
So he understands the technology from the ground up.
Exactly. He gets the complexities their customers face because he's been there. That's invaluable.
And the company's track record under his leadership seems pretty solid. They've navigated all those semiconductor cycles.
They really have. The boom busts, the 2008 crisis, huge technological shifts from one chip generation to the next. And through it all, KLA hasn't just survived. They've thrived. cemented that market dominance we talked about, and delivered really strong returns for shareholders over the long run.
How are they on communication and, culture?
They seem quite transparent. Detailed reports, informative earnings calls. Wallace has this quote, something like, "Management gets the culture they deserve, emphasizing finding and fixing problems fast." That suggests a focus on accountability and an ethical culture, which are good qualitative signs.
Okay, let's talk about the real test. Capital allocation. How management invests the company's money. That's kind of the ultimate report card, isn't it?
It absolutely is, and KLA seems quite disciplined here. Their first priority is clearly reinvesting in the core business to stay ahead technologically. For example, in fiscal year 23, they plowed $1.84 billion into R&D. That's almost 17% of their revenue. That's a serious commitment.
Use that moat wide.
Exactly. Their M&A strategy also looks disciplined, not just growth for growth's sake. Take the Orbotech acquisition in 2019. That wasn't just about getting bigger. It was a smart strategic move.
How so?
It expanded KLA into related high-growth areas like inspecting printed circuit boards, PCBs, flat panel displays, FPDs, and crucial advanced packaging technologies, which are becoming super important for AI chips.
And what about returning cash to shareholders?
They have a very clear policy there, too. They target returning 85% or more of their free cash flow back to shareholders.
Through dividends and buybacks.
Yes. Just recently, April 30th, 2025, they announced another dividend increase up to $1.90 per share quarterly. That marked their 16th consecutive annual increase.
16 years straight. That's a strong signal.
It really is. Shows tremendous confidence in their future cash generation. And alongside that, they announced a new $5 billion share repurchase authorization. So they're actively returning capital through both channels. The dividend growth history is particularly compelling evidence of financial strength and management discipline.
Okay, let's shift to a metric you mentioned earlier, ROIC, return on invested capital. You said it was crucial.
For me, it's arguably the single best quantitative measure of a company's quality and management effectiveness. And KLA's ROIC is, frankly, spectacular. Their trailing 12-month ROIC as of our reference date was 36.77%. Some sources might even calculate it slightly higher, maybe closer to 39.7%.
And how does that compare again?
Well, peers like Applied Materials were around 28.9%, Lam Research about 31.4%.
Yeah.
So KLA is significantly higher. And it's not a fluke. Their average ROIC over the past 5 years has been around 35.8%.
So consistently high returns on the money they invest back into the business.
Exactly. Think about their cost of capital. Their WACC might be, say, 8–10%, maybe 11% to be conservative. Their ROIC is miles above that. That huge spread, that's economic profit. That's what defines a truly wonderful business in Warren Buffett's terms. Every dollar they reinvest generates returns many times its cost. It's powerful proof of their moat and management skill.
Wonderful business indeed. Okay, let's put some more concrete numbers behind these insights. Let's move into Chapter 3, Financial Analysis. All right, let's get into the nitty-gritty of the financials. Again, using June 19th, 2025 as our snapshot date.
Okay, first off, market cap. $115.20 billion, definitely a large cap stock. Revenue growth.
Yeah.
We saw a strong 5-year CGR of 16.5%. Now, yes, there was a dip in fiscal year 24. Revenue went from $10.50 billion down to $9.81 billion. That reflects that industry cyclicality we talked about.
So a temporary dip in a longer upward trend.
That's how it looks. The overall trend is still very positive. But what really blows you away are the profit margins. Looking at the trailing 12 months, PTM, gross margin, 61.12%, operating margin, 42.01%, net margin, 32.02%.
Those sound high, especially for manufacturing equipment.
They are. People call them software-like margins. It speaks volumes about KLA's technological differentiation, their pricing power. They're consistently way above the semiconductor industry average.
And free cash flow. You mentioned they return a lot of it.
Because they generate a lot. It's strong and consistent. Fiscal 22, $3.03 billion. FY23, $3.40 billion. FY24, even with the revenue dip, $3.04 billion. And in the first 9 months of FY25 alone, they pulled in $2.68 billion. That's the cash that fuels the dividends, the buybacks, the R&D. It's the lifeblood.
Okay, what about financial stability? Debt, earnings consistency.
Earnings per share, EPS, shows a really nice pattern over the last decade. Generally higher highs and higher lows. It went from $2.24 back in fiscal 15 all the way up to $24.15 in FY23. And TTM, as of March 2025, was $27.49. That really highlights their growing earning power over time. We can see this clearly in the summary table. Now, debt-to-equity ratio, it's around 1.47 to 1.52 based on recent data.
Which is above 1.0. Is that a concern?
You always look closer when it's above 1, but here it seems very manageable. Why? Because their interest coverage ratio is incredibly healthy, about 30.7x. That means their operating income covers their interest expense over 30 times over.
So they can easily handle their debt payments.
Comfortably. It suggests the debt is part of a strategic capital structure choice, likely optimizing their cost of capital rather than a sign of financial distress.
And liquidity. Short-term health.
Very strong. Current ratio is 2.49, quick ratio is 1.68, both well above 1.0, meaning they have plenty of liquid assets to cover short-term liabilities, no concerns there. And just to reiterate on the dividend, 16 straight years of increases, and the payout ratio is only about 27.6% of their earnings. Very sustainable, lots of room for future increases.
All right, this brings us to the big question for many listeners. Valuation. Is KLA expensive? How does it stack up?
Okay, valuation. If we look at relative valuation first, using the price-to-earnings or PE ratio, KLA's TTM PE was 31.66.
How does that compare?
It's definitely a premium compared to competitors like AMAT at around 20.9 or LRCX at 25.55. It's also significantly higher than KLA's own 10-year historical average PE, which is closer to 21.32.
So the market clearly recognizes the quality and is paying up for it.
That's exactly what it suggests. Quality rarely comes cheap. Now, if we look at intrinsic valuation, like using a discounted cash flow or DCF model, it gets... Well, DCF tries to estimate the present value of all future free cash flows, but it's highly sensitive to your assumptions. Looking at publicly available models, you see a huge divergence. Estimates range from as low as $380 per share up to $1,286.
Wow, that's a massive range. Depends heavily on how optimistic you are about future growth.
Precisely. Key assumptions drive the outcome. For a, let's say, balanced DCF, you might pencil in a growth rate around 10.1% annually for the first 5-10 years, reflecting those secular trends but maybe moderating slightly. You'd use a discount rate, the WACC, maybe around 11%, reflecting current rates and risk, and a terminal growth rate, long-term, perhaps 4%.
But small changes there could swing the value wildly.
Absolutely. That's why sensitivity analysis, testing different growth rates, different discount rates, is so crucial with DCF. It gives you a range of potential fair values, not just one magic number.
Okay, this is really interesting stuff. We've covered the business, the management, the financials. Now things get, well, even more complex as we factor in how the market sees things. Let's move into Chapter 4, Market Sentiment. Market perception, analyst views, technicals. These can really move a stock, sometimes detach from fundamentals. What's the current sentiment around KLA?
Well, looking at Wall Street analysts, the consensus rating is currently a moderate buy. It breaks down pretty evenly. 10 analysts rated a buy, 10 rated a hold.
So positive, but not overwhelmingly bullish. What about price targets?
The average 12-month price target is $807.06, which interestingly is actually below the share price of $871.16 we're using as our reference.
Low.
Yeah, but you absolutely have to look at the range. The target span from a low of $590 all the way up to $980. That huge spread tells you there's significant disagreement among analysts about the near-term outlook and valuation.
What's driving that disagreement? News flow.
The recent news has been sort of mixed in tone. Operationally, KLA beat earnings expectations in Q3 of fiscal 25 and gave pretty optimistic guidance. It's good. But the commentary around the stock in the media and analyst reports is almost always heavily focused on those geopolitical risks we mentioned. That seems to be the main factor, tempering enthusiasm, acting as the primary headwind in people's minds.
Okay, shifting gears slightly, what about technical indicators? Is the market technically strong or weak for KLAC?
Let's look at a couple of things. Short interest first. It's currently about 2.72% of the float. That means about 3.59 million shares were being shorted as of late May 2025.
Is that high?
Not really alarming. Generally, anything below 5% isn't considered extreme. The days to cover, how long it would take shorts to buy back all those shares based on average volume, is moderate, around 3.3 days. So some bearish bets, but not a huge overhang.
And the price versus moving averages?
That looks quite positive, actually. The stock price is trading clearly above its 50-day simple moving average, SMA, which was around $747.54. That's generally seen as a bullish signal for short to medium-term momentum. And importantly, it's also trading well above its longer-term 200-day SMA, which sat around $713.30. That indicates a strong, technically healthy long-term uptrend is still intact.
So technically strong, but analyst sentiment is a bit more cautious due to those external risks. Interesting mix. Okay, what does this mean for who actually owns the stock? Let's look at Chapter 5, ownership structure. Knowing who owns a company institutions, insiders can tell you a lot. What's the ownership picture for KLA?
It's heavily dominated by institutions. About 87.8% of KLA's shares are held by large institutional investors. Think big names like Vanguard, BlackRock, State Street. They're the top holders.
What does that typically signify?
High institutional ownership like this is often seen as a strong vote of confidence. These large firms, the so-called smart money, usually do extensive due diligence before taking large positions, so it suggests they see long-term value. The flip side, though, is potential volatility. If market sentiment shifts and several large funds decide to sell around the same time, it can put significant pressure on the stock price.
Makes sense. What about insiders, management directors? Are they holding much stock?
Insider holdings are actually relatively low, around 0.16% of the shares outstanding. You do see some planned sales reported by executives like CEO Richard Wallace and CFO Bren Higgins.
Should we worry about insiders selling?
Generally, not these types of sales. They're typically done under prearranged Rule 10b5-1 plans. These allow insiders to sell shares over time for personal financial planning, diversification, tax purposes, things like that, without being accused of trading on inside information. So these automatic sells aren't usually seen as a bearish signal about the company's immediate prospects.
Okay. And is ownership concentrated? Does one entity hold a huge chunk?
No, not really. There's no single entity with a controlling stake. It's a pretty typical ownership structure for a large, established, publicly traded U.S. corporation. This generally ensures management is accountable to a broad base of shareholders.
Got it. Okay, now we need to tackle the big one head on, the risks. No investment is risk-free, and KLA, despite its strengths, faces some significant ones, particularly around cyclicality and, as we keep mentioning, geopolitics. Let's dive into Chapter 6, Risk Assessment.
Right. Every investment thesis needs a clear-eyed view of the risks. A SWOT analysis is a good framework here. Strengths, weaknesses, opportunities, threats. We've covered the strengths extensively. Dominant market share, almost 50%. Superior IP and technology. Those incredible industry-leading profit margins, 61% gross, 42% operating. Strong, consistent free cash flow. That exceptionally high ROIC, around 37%. And the resilient, high-margin services business cushioning the cycles.
Okay, what about the weaknesses?
Key weaknesses include high customer concentration. They rely quite heavily on a few very large chip makers like TSMC and Samsung. If one of those giants cuts spending, it hits KLA hard. There's the inherent cyclicality of the semiconductor equipment industry tied to those volatile capital spending cycles. And finally, the need for continuous, very high R&D spending just to stay ahead. That's essential, but it's also a constant pressure on expenses.
And the opportunities.
Huge opportunities lie in those long-term secular growth trends we discussed. AI, 5G, IoT, automotive electronics demanding more complex chips. KLA is perfectly positioned. There's also room to expand further into adjacent markets, like advanced packaging, which is booming. And government incentives like the US TGS Act and similar programs in Europe are actively encouraging domestic chip production, which could create more demand for KLA's tools in those regions.
All right, now for the threats. This feels like where the real weight is.
It definitely is. You have the standard threats, intense competition, though KLA has a strong lead, potential global supply chain disruptions, the risk of a broader economic downturn hitting customer spending. But the critical focus, the biggest elephant in the room, has to be the geopolitical tensions, specifically the ongoing U.S.-China trade conflicts, and, crucially, the U.S. export controls restricting sales of advanced semiconductor technology to China.
And China was a huge market for KLA, right?
Historically, yes.
Yeah.
It accounted for as much as 41% of their revenue in recent years. These export restrictions are directly impacting that. KLA themselves have estimated the hit could be around $500 million to $600 million in revenue just in 2025 because of these controls. That's a significant headwind.
Let's dig a bit deeper into those threats, particularly the geopolitical ones and maybe the macroeconomic factors too.
Sure. On the macro front, things like inflation and higher interest rates directly impact KLA's customers. Building new fabs is incredibly capital intensive. Higher borrowing costs make these multi-billion-dollar projects more expensive, potentially leading customers to delay or scale back their expansion plans. This feeds directly into that cyclicality risk.
Okay, and those proposed U.S. tariffs for 2025, how do they play into this, even if KLA is a U.S. company?
Right. It's not about direct tariffs on KLA's exports from the U.S. It's more about the second-order effects on the global supply chain and customer investment decisions. For instance, if the U.S. imposes those proposed tariffs, say, 20% on equipment from the Netherlands, hitting ASML, or 24% on gear from Japan, it significantly increases the cost for chip makers like Intel or Micron to build their new fabs inside the U.S.
Ah, because those fabs need equipment from various global suppliers, not just KLA.
Exactly. Suddenly, building that U.S. fab becomes much more expensive due to tariffs on other essential equipment. This could lead to delays, scaling back, or even cancellations of U.S.-based fab projects that KLA was counting on for orders. So you see how geopolitical friction elsewhere, even tariffs not directly targeting KLA, can translate into very real business risk for them by shrinking their addressable market or delaying customer spending. It's complex and interconnected.
Definitely a lot to weigh there. So after laying all this out, the good, the bad, the numbers, the risks, what's the ultimate takeaway? Let's try to bring it all together in our final chapter, Chapter 7. Conclusion. We've painted quite a detailed picture here. Strength, weaknesses, opportunities, threats. It feels like a very dualistic story for KLA, doesn't it?
It really does. Let's summarize the two sides. The bull case is powerful. You have what Warren Buffett would call a wonderful business, a near monopolist in a critical niche, protected by a deep technological moat, giving it immense pricing power. The financials are exceptional. Those software-like margins, consistently high ROIC, robust free cash flow generation. It's perfectly positioned to benefit from huge secular tailwinds like AI, 5G, high-performance computing, and it's guided by exemplary management with a proven track record and smart capital allocation. That's a compelling combination.
Hard to argue with that side. But then there's the other side.
The bear case. And it's significant. The geopolitical headwinds are unavoidable and substantial. The U.S.-China conflict and export controls pose a direct threat to a large chunk of their historical revenue and create uncertainty around global customer investments. There's the inherent cyclicality. KLA's fortunes are still fundamentally tied to the volatile ups and downs of semiconductor capital spending. And finally, that premium valuation. A PE of over 31 is steep compared to history and peers. It arguably prices in a lot of future growth already, potentially limiting upside from here.
So the valuation remains a key sticking point. The quality is recognized, but is the price too high?
That's the crux of it. The premium PE isn't necessarily wrong. The market appreciates KLA's quality, but it means you need high conviction that they can sustain strong, double-digit growth for years to come to justify it. And as the wide range in those DCF models showed, future growth is exactly where the uncertainty lies, especially with those geopolitical clouds. So, the concluding outlook, KLA is, by almost any objective measure, a very high-quality, truly wonderful business. Excellent management, stellar financial performance, dominant market position. The core question for you, the listener, isn't really about the quality of the business. It's about the price you're paying for that quality today and the level of geopolitical and cyclical risk you're willing to accept.
Which leads to maybe the final thought for you to ponder. Can KLA sustain that strong growth needed to justify its current premium valuation over the next decade? And perhaps more importantly, how much risk do those significant, unpredictable geopolitical factors pose to KLA's future cash flows? And does that fit within your personal risk tolerance? Something definitely worth mulling over as you consider the future of this often unseen but incredibly vital engine of our digital world. Well, we hope this deep dive into KLA Corporation has given you some valuable insights and things to think about. If you enjoyed it, please do like this deep dive, subscribe to the Stock Analytics AI YouTube channel, it helps immensely. And hey, consider becoming a member to get priority on the tickers you want us to cover.
And just the standard but important reminder, this analysis was generated by an AI system. It's for educational and informational purposes only and should absolutely not be taken as financial advice. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.
Absolutely. Thanks so much for tuning in, and we'll see you on the next deep dive.